I'm here, I'm sharing the handout which I'll be using here, audit of inventory. Audit of inventory. All right. So I'm sharing the handout which I'll be using. Yeah, so there we are. So I would want us to start right away. All right. Great. So remember, this is lecture number 35. Lecture number 35, you're going to enjoy it. Yeah, lecture number 35, substantive testing, research and development, and inventory. So basically, this is IAS 38 and IAS number 2. Now, for those of you who have been in these classes of mine, you know that whenever we talk about substantive testing, from the word substantial, we must always remember these 5 items. For those of you who have got young children, we talk of A, E, I, O, U. A, E, I, O, U. Yeah, those vowels. So we have A is for analytical procedures. So as an auditor, you must always think of how do I carry out analytical procedures? Analytical procedures, yeah, quite heavy, but I have to do them because I'm an auditor. So analytical procedures, yeah. So we have A, I must always do a lot of inquiries because I must do lots of talking. Remember, as an auditor, I'm a detective. Yeah, I'm like a DCI official. So I'm being sent in this case here to go and discover anomalies. So for me to discover anomalies, I've talked to so many people, junior staff at the offices, senior staff at the offices, and also third parties. You must always be, I mean, people should think that you are very, very friendly, but you are gathering information from them. You are gathering information from them. So you must do inquiries, both internal and external. So we have I. I stands for inspection. You must inspect documents. Use your eyes to look at vouchers, to look at, in this case here, any invoices. So inspection. Then we have O. O stands for observation, observation, observation. Then we have lastly U. U stands for at least there is a recalculation, 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 and reperformance, recalculation and what here, and reperformance, like that. At least there is a U in between. So as an auditor, you will be given information. They will come and tell you that, hey, we have done depreciation and it is 10 million. I will never trust these people 100%. As an auditor, I'm called upon to be very, very skeptical, where I have a doubting mind, where in this case, here, somebody will tell you that I was working, but always doubt. Always, as an auditor, you must always do what here? Doubt. All right. As you doubt, what does it mean? This depreciation they gave you, will tell them no problem. Give me your property, plant, and equipment register. Give me your depreciation policies. Then I should be able to do what here? I should be able to calculate this figure myself because it had been calculated earlier on. So then what I'm doing here is to recalculate. Yeah. So these are very, very important. And then, ladies and gentlemen, remember, whenever you hear of audit tests, you must always remember what we call assertions. If you don't understand this, you will never pass your audit paper. So assertions. So assertions, we normally talk over ACCA cover, ACCA cover with a P, ACCA cover with a P like that. So I'm using my substantive 5 vowels. Yeah, again, it's these assertions. So assertions, of course, these are the beliefs. When these managers give us their financial statements, they want us to believe that those figures which are therein are accurate. A stands for accuracy. We have in this case here, see, they want us to believe that those figures are complete. The figures in the financial statements. All right. So in this case here, we have a C that they have been classified properly. So classification. So as an auditor, I have to doubt this belief, what they want me to believe. I have to doubt this, ladies and gentlemen. If, for example, I'm auditing inventory, I have to look and just ascertain that this inventory item has been classified properly on the face of these financial statements under current assets. So the classification is really, really important. Yeah. Then we have the next A. The next A, ladies and gentlemen, stands for allocation. Allocation, basically, we are looking at the common expenses that we call what here? We call overheads in management accounting. How have they been apportioned? Is the apportionment fair? Is the apportionment fair? When they tell you in this case that this overhead, the whole of this overhead was put under warehouses, you have to ask them, which criteria did you use to apportion the entire rent, for example? Yeah, so allocation is really, really important, very close to classification. But basically, whenever you hear about allocation, remember that allocation is more to do with the common expenses. All right, so we have ACCA cover. The next one is C. C in this case here, which stands for what here? Cutoff. So remember, cutoff expenses, items of 2025 should be booked in, should be financially reported under the year 2025. We should not have a scenario where sales of 2025 is being reported in 2026. So at the end of the year, the auditor must be very, very careful with cut-off to ensure that the transactions that you have in 2025, they were supposed to be in 2025. So remember, normally what happens, most of these directors, they would want to embellish. They would want, in this case, to do what we call window dressing. So the house may not be very, very beautiful, but they're putting very good curtains. Yeah. So in this case here, for example, somebody calls around the 31st of December 2025. A potential customer calls and places an order, tells RCM 31st of December 2025 that RCM, I want to buy this number of units from you worth 40 million. Worth 40 million. So you see, I mean, this person, we haven't, this person, in this case here, we haven't invoiced this person by end of this year. There are no goods received notes because, I mean, we haven't sent the goods to this person. Nothing really, apart from expression of interest, has happened here, ladies and gentlemen. Then in that case here, this particular sale, of course, will be done in 2026. So those are the kind of things that I expect you good students of mine to be mentioning, that by the end of the year, to check the cutoff, I'll, for example, be looking at the checks thirds. Yeah, for example, the checks that were issued for the last 5 days of the year. Yeah, in this case here, what happened there? All right, so I don't know who this ninja is. Yeah, great. So great. So we shall overcome. Great. So it will be very important for us to check what we call the cutoff. The cutoff. Now, I'm so sure your classmates have not understood that we have this class here. If they understood what they're missing, all of them would be here really. I'm so sure you guys haven't yet sent to them the link to this class, because this is a session that they can listen to even when they are in their vehicles going back home. Yeah, please send them. Send them the link that you used to join here. Invite your friends to join, because this is a very, very important session. So we have here, remember the rule we are using is ACCA cover for assertions, cover P. So then we have been able to look at the cutoff. Then we have O. O is for occurrence. You know, in most cases, these directors of these companies, gentlemen, they are not very, very honest. They are telling you that whatever you are seeing on the financial statements, the numbers you're seeing on the financial statements represents activities that really occurred. In most cases, those things are hooked. People try to create higher sales. They never occurred. They're trying to create a higher sales for them to create a higher profits, simply because they are doing manipulations of financial statements for purposes of them getting a loan from a bank. So as an auditor, I have to assess this occurrence. All right. Then we have valuation. The auditors are telling us that, not auditors, but directors, they are telling us that whatever you are seeing captured on the financial statements has been valued correctly. In most cases, that is not the case. The valuation there depends on where are they taking these financial statements. If they're taking the financial statements to KRA, they would want, in this case here, to understate items. So we must ensure that proper valuation happens. Then we have, ladies and gentlemen, existence. E for existence. So existence, basically, they're telling us that, especially on the property, plant, and equipment, that whenever you see us saying that we have got a PPE value of 50 million, and under PPE of 50 million, we have motor vehicles, we have, in this case, so many things, that those things exist. Trust you me, under Aura and the core certified public accountants, we have done a lot of audits. For the number of years you have existed, we've done a lot of audits, and I can tell you, somebody will tell you that they have motor vehicles on the ground, but the real picture is that they are not motor vehicles at all. You'll even get like a motor vehicle belonging to a particular entity. Yeah, when you go to audit, you realize that that motor vehicle is being used by a director to do their own private issues. So it exists, but doing the wrong thing. Existence. Then we have, ladies and gentlemen, something very, very important that you must always test. We call this rights and what here? Rights and obligations. Rights and obligations. Rights and obligations. So like this is really, really important. So this basically is proof of ownership. So when you tell me that you have a motor vehicle, I can only trust that you have this motor vehicle, ladies and gentlemen, if I see ownership documents, the logbooks. If it's land, I would want, in this case here, to see what here? I would want, in this case here, to see title deeds. If it is inventory, I would want to see the invoices. Yeah. A supplier brought these goods. Did they invoice you? Yeah, I would want to see purchase orders. I have to do vouching for me to be able to really be contented that these stocks belong to you. Yeah, rights and what here? Obligations. And then lastly, we have what we call presentations of the financial statements. Presentations and disclosures, because in the notes, I would expect to see notes to the financial statements. I would expect to see the policies. What policies do you have under inventory? Yeah, I would expect to audit this. So I would want to know whether, ladies and gentlemen, up to here, are we really okay? To use a few minutes here to bring you up to speed. Up to here, somehow, are we really, really okay? Are we okay? Are we okay? Are we okay? Great. Thank you so much. Then I should be able to look at a past paper question. Yeah, this past paper is quite, past paper question is quite nice. So you're told here substantive testing, research and development and inventory. This session focuses on substantive procedures related to the valuation of inventory and the auditing of research and development costs. So we have the first question, which is coming in the form of a scenario. Remember, in your exams, you shall be given many, many scenarios. Hyacinth Company conducted a year-end inventory count. The audit firm confirmed that controls and the processes for recording work in progress and the finished goods were acceptable. The audit firm, which is my audit firm, has confirmed that the controls here are working. So it means that for the items that the controls are working, I will not do substantive testing. Yeah, so in this case here, nothing to do with work in progress. I'll be checking here. Yeah, So the audit team also confirmed the quality and the stage of completion of work in progress. So no further audits to be done on this because we have confirmed the quality. We also know the stage of completion. There are 30%, there are 60%. To the inventory count, it was discovered that a batch of a product line called Crocas, produced to meet customer-specific technical requirements, did not meet the customer's quality and the technical standards. We had produced some goods here known as Crocas for some customer, and this customer was not happy because whatever quality of Crocas we produced did not meet his specific technical requirements. This inventory had a cost of $450. However, following discussions with the production supervisor, the finance director believes that this inventory can be sold to alternative consumers at a discounted price of 90 USD. So remember, it's called the IAS 2. You don't have to quote them, but at least you should be able to show that you understand the inventory procedure. So IAS 2 tells us that we shall always capture or value inventory at the lower of cost or net realizable value. So these items cost us 450. We have been capturing them on our financial statements at 450 as inventory, but we can only sell them outside there at 90. So I'm able to see impairment straight away. Why? Because 450 is the cost, and this 90 is what we call the net realizable value. If I sell it, I'm selling this to other people, so I can only get 90 there. All right. So I'm able to see impairment loss. You see, as I read this scenario, as an auditor, remember I'm being sent here to go and detect anomalies in the financial statements regarding this inventory. So as an auditor, I'm supposed to be a detective, a DCI officer. There'll be a lot of interrogations happening here. So for example, you can see this production supervisor was talking to the director. I would also, as an auditor, want to talk to him through what we call inquiries. This director, or rather this production supervisor, I must do inquiries. I must talk to him and record. As I talk to him, remember inquiries, we always think about internal and external. So to be able to substantiate that whatever he's telling me, which of course must be what he told the finance director, that these spoiled goods, these defective items have a market out there. So I would want to ask this person, are you so sure that these brokers will be able to sell out there? Very good. Give me this new customer who wants to buy this defective item. Give me his purchase order. Yeah, because as auditors, we always prefer, in this case here, written evidence. Give me the purchase order. If he tells me no, he has not given any purchase order, I'll give him like 3 days. Tell him to request this customer to put his order down in writing. All right, that will really be very important. And if possible, myself as an auditor, I should also be able to ask for permission from this client, even to talk to this prospective customer. So long as I get permission from the client, because if it's an inquiry, I'm really inquiring. I must be very inquisitive. Again, remember, as an auditor, if you don't reason like this paper cannot be very friendly to you. Yeah, as an auditor, you are a DCI officer. You are going to do a thorough investigations down there. So now I'm reasoning, but first of all, before I reason, let's look at requirement. They want us to describe the substantive procedures an auditor should perform for the evaluation of what year inventory, 6 months. I'm telling you, these are paper I've marked before. And I can assure you that there will be very few students who will be able to get even half of these marks. Because many students don't reason like detectives, police officers, when they are going for this kind of a question. So when I go for this kind of a question, first of all, remember, they want me to value the entire inventory. In this entire inventory, there is good inventory and there is the crocus, bad inventory. So then I will be thinking about so much as a detective. Remember, detective, I'm doubting. Who am I doubting? The preparers of these financial statements. Who are the preparers of these financial statements? The directors of the company. I'm doubting them. On what basis am I doubting them? On the basis of the assertions. So, for example, they have told me that those inventory items are there. So, existence, do they really exist? So under existence, what will I be able to do as an auditor? Under existence, ladies and gentlemen, for example, during stock count, when they are counting their stocks, I would want to be there physically, or rather even, an employee of Aura and Co. should be there. And during this inventory count, just to get everything very well on a sample basis, I will ask my person who is there under Aura and company audit firm. Ladies and gentlemen, I'll ask that particular person on a sample basis, they should be able to go to some shelves. Yeah, even if it is just small sample, 30 units, 40 units. Whenever you get an opportunity, please count yourself to see whether under that shelf, if they are said they have 30 units, are you able to confirm that they are 30 exactly? Because you are doubting these people' existence. Under existence, it is not all the inventories that these guys have in their warehouses that are theirs. There could be goods that are consigned to them. Goods in this case, ladies and gentlemen, that belong to third parties that have been brought to our supermarket so that we can sell them. They're not ours. We have only been given the right to sell. As an auditor, to confirm that such goods are there, I'll have to inquire of the same from management. Do you have any consigned goods? We call them goods on consignment. And that is why it is very, very important, even before you come to this kind of stock take, you must look at various policies, look at various files in the office, ask for contracts, see whether they are doing consignment accounts. Yeah, try to understand really what kind of inventory model they have. So I'm in this case here, I'm a detective. So are they existing? Very good. Number two, are they valued properly? Have they been valued properly? In most cases, I'm doubting them. The valuation may not be right. Like this valuation, ladies and gentlemen, I can see we have some goods here that have been impaired. The cost is higher than the net realizable value. I would want to see how they have captured the difference. The difference between 450 and 90, 450 was the cost. 90, ladies and gentlemen, in this case here is what we can sell these goods at. That difference there is what we call impairment loss. Has that entry been passed to the balance sheet? Yeah, you go to inventory, subtract that impairment loss. And this impairment loss, has it been captured in the income statement properly? Because, ladies and gentlemen, under those assertions I gave you, we have an assertion known as what here? We have an assertion, ladies and gentlemen, if you remember very well, we have an assertion called classification of items. Yeah. So under valuation, have they used IAS 2 concept that inventory, especially the defective inventory, has been valued at the lower of cost or rent reasonable value? In most cases, they'll not have done that, and yet they're telling you that they are valued correctly. Remember, ni kuwatoanisha. My model, ladies and gentlemen, in this case is to go and show them that you guys have not done this thing correctly. All right. Now, even on valuation, I would still ask to see how genuine this person who is expressing interest to buy these brokers items which are defective at 90. I would want to genuinely establish, or rather establish how genuine he is, because someone will come and they just place a bet and they're not serious, All right. Then, of course, we have the concept of rights and obligations. Remember, you can only say, ladies and gentlemen, that you have a right to this inventory if you own them. Remember, inventory is not to be having, not unless you're dealing with these big inventory items like cars. These small inventory items, ladies and gentlemen, you will not be having logbooks. You will not be having title deeds. No. But I mean, I would want to know whether you genuinely purchased these items. So I would want to see the purchase invoices, the goods received, notes, copies, etc. I would want to talk to the management regarding, in this case here, their quality assurance processes. All right. So like, for example, how do they identify? I mean, if the crocus is spoiled, how do they? So those are the kind of things I would want you guys to be talking about. So key considerations for valuation, I'm reading the solution. The valuation assertion for inventory as per IAS to inventories dictates that inventory should be measured at the lower of cost and net realizable value. Net realizable value is the estimated selling price in the ordinary cost of business, less the estimated cost of completion and the estimated cost necessary to make the sale. The problem explicitly states that the inventory in question, crocus, has a cost of 450, but an estimated selling price of 90. This immediately signals a potential impairment. So substantive procedures, the procedure should focus on ensuring that inventory is recorded at the lower of cost and net realizable value, specifically addressing the defective crocus batch and the general inventory valuation. Substantive audit procedures for inventory, the objective of these procedures is to obtain sufficient appropriate audit evidence regarding the assertions related to inventory as presented in the financial statements. As per the case, the audit team attended the year-end confirmation and found controls and the processes for recording WIP and the finished goods acceptable and confirmed their quality and the stage of completion. Therefore, procedures typically performed at the physical count, e.g. observing client count procedures, selecting items for test counts, would have already been completed, and these procedures focus on subsequent steps. Because at the control testing, we realized those things were working well. So then the first procedure here is to test existence. Remember I told you, ladies and gentlemen, if you remember very well when we began these sessions, I told you that assertions are as important as goalposts are to a footballer. If, for example, it doesn't matter how nice a footballer is, yeah, PSG, whatever, it doesn't matter how good they can dribble the ball all the way to the high heavens. But if they don't know pass the ball in, writing those procedures without saying what assertion you are testing, you always keep on failing in this particular paper. Okay, great. Great. I can see my internet is unstable. I don't know whether I'm back. Are you guys able to hear me now? All right. I hope now I'm back, Winnie. I hope now I'm back, Winnie. Am I back? Am I back? Am I back? Are you able to hear me now? All right. Thank you so much. All right. The question, remember the question, I'm reading my question from here. People tell you where they come from. For now, let me just continue here. So existence, to confirm that the inventory recorded in the financial statements physically exists at the reporting date. So procedure 1, for a sample of items selected from the inventory master file, trace the quantity and description to the physical inventory count sheets, yeah, or perpetual records in the computer, and confirm their presence during the physical inventory observation. Yeah, so we are looking at inventory valuation. Yeah, we're looking at inventory valuation. So, ladies and gentlemen, what they're telling us here for confirmation, of course, you'll be given a list of the inventories, paper. It could be a computer printout or whatever. If they tell you in this case here that these particular inventory items are 30 on the shelves, on test basis, you as an auditor, of course, you don't have to do the whole thing. Ours is about sampling. So I will be able to pick like this item, check physically, are they in existence? That is important. So for a sample, the English may not be very, very good. For a sample of, I mean, it's good, but very difficult. For a sample of items selected from the inventory master file, trace the quantity and description to the physical inventory count sheets or perpetual records and confirm their presence during the physical inventory observation, if this was part of the earlier attendance. Procedure number 2. Where inventory is held at third-party locations, where you're told in this case that there is some inventory of ours, which for example is in this supermarket, what we call consignment, e.g. public warehouses, like now the vehicles, people sell vehicles. So you have your own yard here, but on Sundays, you must take these vehicles, for example, to Nyayo Stadium around there. So you see now your inventories are in third-party premises. Obtain direct confirmations from the custodians of the inventory regarding quantities held on behalf of the client. Where you have agents selling for you and you've taken these vehicles here to your agents, as an auditor, I have the right, of course, through your permission, to talk to those agents to tell me exactly what they have that belongs to you. Now, as a gentleman, remember one of the assertions is completeness. In many, many cases, these directors may capture things that are not complete. Why, as I told you, always many companies will have two sets of financial statements. There are those sets of financial statements that will be taken to KRA. Those ones, in most cases, many directors, like 30% of these companies, or even 40%, or even a higher percentage, they would want to declare losses. But wait until you get the financial statements that they take to the bank to borrow. Hey, huge profits. How I wish even today, KRA would get to see the proposals that most companies write to banks. If they could just work together, KRA will be able to fetch lots of taxes. Lots of taxes. So like inventory, ladies and gentlemen, inventory is a sensitive thing. You see, in inventory, the moment you overstate your inventory, you overstate your income. Whenever they want to create bigger incomes, they always overstate the inventory value. Whenever, for example, they want to understate their incomes for purposes of taking smaller profits to KRA, they understate inventory. When they understate inventory, it means that the inventory is captured on the financial statements are not complete. They are not complete. So as an auditor, I must be aware that completeness assertion is really, really important. So completeness, so objective to confirm that all inventory that should have been recorded is included in the financial statements. Procedure number 1. From a sample of inventory items physically observed during the count, trace that quantity and description to the inventory count sheets and subsequently to the inventory master file and the financial statements. That whatever you are able to count, trace that particular number that you counted to your master file yourself, because you will normally do test counts, sample counts. Trace and see whether that is what was written. That is what is written down in the master file. Whatever is written down in the master file will always find their way onto the computations that go to the financial statements. Procedure number 2, cut-off testing. These I will really review with you many times. Review receiving reports and the shipping documents, e.g. goods received notes and the goods dispatch notes, issued just before and after the year end. Compare this to inventory count sheets and the sales purchases records to ensure that inventory movements are recorded in the correct accounting period. So inventory coming in, goods received notes. Inventories that we're selling, goods dispatch notes. At the year end, there will always be that confusion. There'll always be that confusion. So the goods that have been received towards the year end and we have stamped and signed that we received them, I will have to trace this to the master file. Yeah, and see whether this particular figure is appearing in the financial what year? In the financial statement. Sorry, just a minute. Yeah, I hope there are no chats. Yeah, great. No chats. Let me just continue here. So completeness, or the inventory items that we expected to have at the end during this year, are they have they been captured completely? Very, very important. Then we have number 3, rights and obligations. Rights, of course, here we are looking at are these inventory items for sure ours? The objective is to confirm that the entity holds or controls the rights to the inventory at the reporting date. Procedure number 1, examine a sample of purchase invoices and supplier contracts for inventory additions to verify legal ownership and the terms of purchase. I told you, most of the inventory items, of course, these are small items. You can't be having like ownership documents directly, like how we have logo books for motor vehicles. So for these small inventory items, of course, what I would want to see are the purchase contract agreements here. How are they? Yeah, we did a purchase order. Please, as an auditor, give me this. There are invoices to show that you have paid. If you received them, please give me this. Yeah, in this case here, there are, for example, receipts on purchasing. Yeah, please give me these receipts. So examine this sample invoice and supplier contracts for inventory. Procedure number 2, yeah, talk to management and inquire of management and review board minutes for any inventory, for any evidence of inventory pledged as collateral for loans or subject to other encumbrances. So under rights and obligations, and this is normally a free mark. Remember, when you have pledged some assets, those assets here are supposed to be reported differently. Yeah, because there is a loan attached to them. Yeah, remember, once you have given out something as collateral, once it is charged, it ceases to be yours per se. Yeah, so we have to review these contracts a lot. Procedure number 3, be alert for any inventory on consignment held for sale on behalf of others or third-party owned inventory, ensuring it is not included in the entity's recording inventory. Of course, as I do this at first, you guys will think that it's quite a difficult area, but when I repeat it second time, you'll be able to understand it fully. Then we have the concept of valuation and allocation, objective to confirm that the inventory is valued appropriately at the lower of cost and net realizable value. And then any allocations are reasonable. So cost verification. Yeah, how do I verify this cost? Yeah, of course, I will have to, I know these things were sold to us. So do we have any purchase invoices? Obtain the detailed inventory listing and reconcile it to the general ledger balance. For purchased inventory, vouch a sample of recorded costs to supplier invoices. For manufactured inventory, work in progress and finished goods, review the company's cost accounting system, including the allocation of overheads for reasonableness and consistency. Vouch a sample of direct labor and material costs to supporting documentation. Because remember, ladies and gentlemen, you paid the workers, right? So payroll records, material acquisitions, etc. Net realizable value assessment. They are telling you that this thing is worth 90. We need to assess, because we are detectives. We are like policemen who are out to discover anomalies. So select a sample of significant inventory items or product lines sold after the year end. Compare their selling prices to their carrying values at the reporting date. If selling prices are consistently lower than the year-end carrying values, it suggests that net realizable value was overstated and a write-down may be required. Listen and listen to me very well. You see, when goods reduce their value, in most cases, the directors would want to hide that because they know that, yeah, So are we still together? Are you guys able to hear Mwalimu? Please confirm whether you're able to hear me. Please confirm. Yeah, thank you so much. So they know that once these goods prices have started going down, the auditor will ask for impairment, which will affect their financial statement. So you see they have finished their financial reporting in 2024, end of year. So come month number 1, January 2025, they'll give me the financial reports to audit. So the very first thing I'll do under their sales, I would want to know how much are they selling their goods at? The year end, they were selling at say 40, 50. Now they are selling at 30. Then I know there is an issue with the impairment. IAS 2 has to apply. Has to apply. All right. Yeah. So procedure number 1, post year-end sales. Yeah, select a sample of significant inventory items or product lines sold at the year end, compare their selling prices to their carrying values at the reporting date. Very, very important. Procedure number 2, identification of obsolete or damaged goods. Review inventory aging reports to identify slow-moving or obsolete items. The aging report, this is that report that normally guys see that this, for example, for supermarkets, that these items have stayed for those items that have stayed with us from day number 1 to day number 30, 31 to day number 60, 61 to day number like that. So that has always to be reviewed. And when you see goods taking unnecessarily longer time, they are not moving. Those things have become obsolete. Yeah, reviewing inventory aging reports to identify slow moving or obsolete items. Discuss, because auditors is all about talking. It's all about inquiries. Discuss with management the reasons for slow movement and any plans for disposal or repricing. They have to reduce price. Inquire of production and sales personnel about potential obsolescence due to technological changes, market demand shifts, or product defects. Ladies and gentlemen, you are dealing with copy typewriters. Obsolete. I will have to know the policy of management. During physical observation, if conducted, specifically note any visibly damaged or deteriorated items. My internet not very good. Please let me know once I come back. My internet is disturbing me. Let me know once I'm back. Let me know once I'm back. It's okay now, right? It is okay now, right? Winnie is confirming it's okay. Beatrice is confirming. Thank you so much. All right. So specific procedures for Crocus, that particular product line that was defective. Obtain and review quality control reports related to the Crocus product line. Compare these reports directly against the customer's technical specifications to confirm the reported failure to meet standards. Request and review concrete evidence of alternative customer interest for the defective Crocus batch. This could include formal offers, written correspondences, or draft sales contracts to substantiate estimated selling prices of 90 per unit. You can see recalculate impairment loss for the Crocus inventory batch. Mathematical accuracy, this one we call it casting. In audit, we call this one here casting. C-A-S-T-I-N-G, casting. Recalculate the extensions, that is quantity times price. Yeah, the net realizable value total, and the foot, that is the sum, the inventory listing to ensure mathematical accuracy. So basically, get the inventory listing. They have given you, they have got product X at 20, product this at 30, add. Cast this using normal Excel. Procedure number 2, verify the application of the lower of cost and net realizable value rule on an item by item basis. Then we have, lastly, I hope this is the very last one, presentation. Yes, this is the last one normally, presentation and disclosure. So the presentation, of course, how have they presented the inventory items? Is it properly disclosed? Is it properly disclosed on the notes? Presentation is about, if it is in the statement of financial position, has it been classified correctly under current assets? Are we able to see this closing in inventory and the cost of sales in the income statement? Yeah, so in this case here, to confirm that the inventory is appropriately classified, described, and disclosed in the financial statements in accordance with the applicable IFRS. Procedure number 1, review the financial statements to ensure inventory is correctly classified into categories such as raw materials, etc. Procedure number 2, examine the notes to the financial statements to ensure that all required disclosures related to the inventory are present, including accounting policies for inventory valuation. This for the disclosure. Yeah, did they use FIFO or weighted average? The total carrying amount of inventory broken down by classification. The amount of any inventory carried at net realizable value. The amount of any inventory pledged as collateral. Procedure 3, compare the presentation and disclosures to the requirements of IAS 2 inventories. So, ladies and gentlemen, I don't want you to cram this the way I've been able to read it. If you're told to audit inventory, my good students, what is it that you can never forget? Just one sentence about audit of inventory, because this is really very, very popular in your exams. I want to see whether I've been effective. I could be teaching you in this case here without being effective. Yeah, so what Raimi Jr. is telling us is that he will be able to look at the assertions. Do they exist? And then I would want it now to be seeing now, using now those assertions and the technical jargon, audit procedures, check, examine. Look at this, observation, inspect. Yeah, rights and obligations. So I would want to check whether these inventory items belong to the customer. So check these invoices, check. Yeah, ACCA cover P, I love that for the assertions. Because trust you me, there are so many students who come to me. They tell me, Mwalimu, I always think that I know this paper, but now I'm failing this paper for the 4th time. It's because they have not understood the answering technique. Yeah, where they are correctly valued, Winnie, I love that. Yeah, how do I check this? So first of all, if it's valuation, I'll even be able to mention the concept of what here, selling price times quantity. Yeah, the casting thing. So this valuation, I'll be able to state there that there is the concept of them being valued at the lower of cost, net realizable value. There are so many things I will be able to even go to the management and tell the management to write a representation letter. Yeah, write a representation letter regarding the value that they have been able to value correctly. So ACCA cover P, can somebody help me answer that, because I've tackled it in this class? Somebody help me answer that as I go to the last area, because I need to go to another class. Ladies and gentlemen, we have this other standard called IAS 38. IAS 38, research and development costs. So remember, I'm required here to know some high level understanding of this IAS. Like now, IAS 38, if we have a research and development department, whenever you incur research costs shall always be expensed. That's what I'll write in my paper as I start off this IAS 38. Research costs shall always be expensed. Development costs shall always be capitalized in the balance sheet, in the statement of financial position. But for development costs to be capitalized, there are conditions that have been able to develop this product to a level that can sell, that I already have what we call a prototype. I hope you guys know what a prototype is. Yeah, that I've been able to do, that is what we call technical feasibility, that I've got enough finances, even after producing this prototype, I've got enough finances. Thank you so much, Beatrice. I've got enough finances to ensure that I complete the entire prototype now to a sellable unit. This is very easy, really. Thank you so much, Monica. This is very, very easy, really. Very, very easy, really. So we are told here, ladies and gentlemen, substantive procedures for research. So the scenario, the company has incurred research and development costs. It's an intangible asset. Developed research and development are amortized here on a straight line basis over 4 years. Requirement, describe substantive procedures you should perform to obtain sufficient appropriate audit evidence regarding research and development costs. 4 marks. So many guys will start here with the procedures. No, I must always start with assertions because, ladies and gentlemen, remember, I'm a detective. I'm a police detective. I would want to know whether even this particular intangible asset occurred, whether it exists. Has it been valued properly? Yeah, that's how we reason here. So we are told, ladies and gentlemen, here very, very fast. Key considerations for research and development, IAS 38, intangible assets, provide specific criteria for capitalization of development costs. Research costs are expensed as incurred. Yeah, they normally go to P&L. Development costs are only classified, or rather are only capitalized if all 6 criteria are met. Technical feasibility of completing the intangible asset so that it will be available for use or sale. Intention, there is an intention to complete the intangible asset and use it or sell it. Ability to use or sell the intangible asset. If you're not able to use it or you're not able to sell it, that cannot be capitalized. That will be expensed. The expense will go to the P&L. How the intangible asset will generate probable future economic benefits here. Remember, it's an asset, so it has to bring in future economic benefits. It has to bring in cash flows. So we have availability of adequate technical, financial, and other resources to complete the development and to use or sell the intangible asset, ability to reliably measure the expenditure attributable to the intangible asset during its development, substantive audit procedures for research. And the objective of this procedure is to obtain sufficient appropriate audit evidence regarding the recognition, measurement, presentation, and disclosure of research and development in the financial statements in accordance with IAS 38, intangible assets. Let me read this a bit, just a minute. I can see some charts. Yeah, Winnie, thank you very much for notifying me. I'll just finish this pretty fast. Thank you. So existence and rights and obligations, I told you must always start with assertions, objective, to verify that capitalized research and development intangible assets exist and that the entity has control over the future economic benefits derived from them, including legal rights where applicable. Procedure. Inspect supporting documentations for technical feasibility, such as engineering reports, scientific findings, prototypes, or test results to confirm that the development project has reached a stage where its completion is technically viable. Another procedure, obtain and review internal documentation such as market analysis, business plans, or preliminary customer feedback to assess the existence of a market for the output of the research and development project, thereby supporting the probability of future economic benefits. Review project budgets, forecasts, and resource allocation plans to ascertain the availability of adequate technical, financial, and other resources to complete the development and subsequently use or sell the intangible asset. So you have to look at the budget of this particular organization. Do they have resources to complete this prototype to the end and then they sell? Another procedure, examine irrelevant legal documentation such as patent applications, intellectual property registrations, or licensing agreements to confirm that the entity's legal rights and control over the developed intangible asset. You don't have to master them the way they are, the way they're written here. No. Valuation and allocation. Objective is to ensure that research and development are accurately measured, that only eligible development costs are capitalized, and that capitalized amounts are appropriately amortized over their useful life. Procedure cost verification. Obtain a detailed schedule of all the capitalized R&D expenditure for the period. Select a sample of these costs and vouch them to support documentation. Yeah, if you are procuring raw materials, such as supply invoices for materials, payroll records for direct labor, and expense claims to confirm their accuracy, eligibility for capitalization, and direct attribution to the development project. Procedure, amortization policy review, obtain the company's amortization. You know, intangible assets are supposed to be losing value. Tangible assets lost in value, we call that one depreciation. Intangible asset loss of value, we call that one amortization. So as an auditor, I'm interested in knowing whether this amortization has been done correctly because it affects my value. So recalculate, obtain the company's amortization policy for the capitalized R&D. Assess its reasonableness by considering the estimated useful life for years in relation to the nature of the intangible asset, technological obsolescence risks, and by comparing it to industry benchmarks or similar projects. And then amortization recalculation, you must recalculate yourself. Recalculate the amortization charge for the period based on the capitalized amount and the established straight line amortization policy over 4 years. Compare this recalculation to the amount recorded in the financial statements and investigate any significant differences. Then we have the last thing here, ladies and gentlemen, what we are calling here presentation and disclosure. This will always be there to confirm that R&D costs are appropriately classified, described, and disclosed in the financial statements in accordance with the IAS 38 and other applicable financial reporting standards. Procedure. Review the financial statements to ensure that capitalized development costs are correctly classified as intangible assets. Remember, the development cost which is to be capitalized will be called intangible asset. Examine the notes, the financial statements, to ensure that all required disclosures relating to R&D are present, including the accounting policy for capitalization and amortizations of research and development costs, the useful lives for amortization, e.g. 4 years, the gross carrying amount and accumulated amortization at the beginning and the end of the period, a reconciliation of the carrying amounts at the beginning and end of the period, showing additions, amortizations, impairment, and other changes. Procedure, compare the presentation and disclosures with the specific requirements of IAS 38, intangible assets, to ensure full compliance. Ladies and gentlemen, I would want to simplify this. Whenever it comes to IAS 38, intangible assets, research and development, what I will do, I know all those costs that you indicate which are preliminary. Yeah, those ones here will be taken straight away under research. And all research costs, we shall be able to take those ones to the P&L. Look at Tullow Oil Company. When it went, in this case here, to Turkana, yeah, they were doing exploration, trying to see whether there is oil down there. Yeah, so before they start taking down the rigs, they have to do a lot of surveys. So all those surveys they normally do, that is simply research. Those expenses in this case here, they are putting before they start sinking down the rigs for oil now, mining of oil. Ladies and gentlemen, it will be very important for us to appreciate that those expenses are research-based and they will go to the P&L. So if I'm told to vouch to audit these research costs, of course, I know there are third parties being used. There are those people who are coming in this case here to put their machines here and there. So I would want to get their contracts. Yeah, I would want to get to see their invoices. Those are the kind of things you write to see where they exist. I would want to see their presentation, yeah, in the income statement. I would want to see the policy of this under the disclosures, under the notes of the accounts. So if it is these development costs, now, by the time we are saying that down there is oil, yeah, we shall be able to sink maybe one well. So we reach down there, we see the oil deposits are there. Yeah, then we'll be able to see whether they are technically feasible. Do we continue with this project? If we say we are going to continue the project, then we have met the first condition of what here? The first condition of now capitalizing. The first condition for calling these development costs. And if they're development costs, then automatically they shall be capitalized. But now remember, you must be able to prove to us that this particular prototype, this particular wells we are excavating, they shall be able to give us cash flows in the future. Yeah, that, ladies and gentlemen, at the end of the day, there are resources to the company for us to be able to take them to our financial statements as intangible assets. And once we take them to our financial statements as intangible assets, then there is impairment. I want to see the impairment. How has it been done? Now, the moment you have general understanding, and then you are doing this as a great footballer, who wants to score. And how is scoring? We're scoring against goalposts. What are our goalposts? These are assertions. You can never go wrong. You can never go wrong. You will pass this paper even without really lots of reading. I hope, ladies and gentlemen, I've been helpful to you. We have now come to the end of our lecture number 35. Mine to you is bye. Be blessed. I will be able to answer that question, Bossy, later. Don't worry, I'll tell you. Thank you.